Math questions are a common part of the property and casualty insurance exam, testing your ability to make accurate calculations under pressure. In this video, we'll cover premium and rate calculations, loss ratios and claims math, and deductibles and payouts. And don't miss what's happening in the bottom corner. It's designed to supercharge your exam prep. We'll explain more in just a minute. Let's dive in and get started.
Premium and rate calculations. Base premium using rate times units times modifiers. What is the base premium if the rate is $5, the units are 100, and the modifier is 1.2? Is it A, $500, B, $550, C, $600, or D, $700? The answer is C, $600. The base premium is calculated by multiplying the rate, $5, by the units, 100, and the modifier, 1.2, which equals $600. A contractor needs to calculate the base premium for a project with a rate of $10, 50 units, and a modifier of 0.9. What is the base premium? Is it A, $450, B, $500, C, $475, or D, $400? The answer is A, $450. The base premium is calculated as $10 times 50 times 0.9, resulting in $450.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
If the rate is $8, units are 75, and the modifier is 1.1, what is the base premium? Is it A, $600, B, $660, C, $680, or D, $720? The answer is B, $660. The base premium is calculated by multiplying $8 by 75 and 1.1, which equals $660. Short-term and mid-term policy premium calculations. A client requests a 6-month auto insurance policy. If the annual premium is $1,200, what is the premium for the short-term policy? Is it A, $400, B, $600, C, $800, or D, $1,000? The answer is B, $600. The premium for a 6-month policy is typically half of the annual premium. Therefore, $1,200 divided by 2 equals $600. What is the typical method for calculating a midterm policy premium? Is it A, pro rata basis, B, flat rate, C, discounted rate, or D, annualized rate? The answer is A, pro rata basis. Midterm policy premiums are usually calculated on a pro rata basis, meaning the premium is proportional to the time the policy is in effect. A homeowner cancels their policy 3 months into a 12-month term. If the annual premium is $1,200, what is the refund amount? Is it A, $300, B, $600, C, $900, or D, $1,200? The answer is C, $900. The refund is calculated by subtracting the earned premium from the total. $1,200 divided by 12 months equals $100 per month. 3 months equals $300 earned, so the refund is $900. Endorsement adjustments and territory rating. What is the primary purpose of an endorsement adjustment in insurance premium calculations? Is it A, to cancel the policy, B, to modify coverage terms, C, to increase the deductible, or D, to provide a refund? The answer is B, to modify coverage terms. Endorsement adjustments modify the terms of an insurance policy, which can affect the premium by adding or removing coverage, thus ensuring the policy reflects the insured's current needs. A homeowner in a high-risk flood area receives an endorsement increasing their premium. What is the likely reason for this adjustment? Is it A, improved property value, B, reduced coverage, C, increased risk due to location, or D, policyholder's age? The answer is C, increased risk due to location. The endorsement likely reflects the increased risk associated with the homeowner's location, necessitating a higher premium to cover potential claims. How does territory rating affect insurance premiums? Is it A, adjusts premiums based on location, B, determines policyholder's credit score, C, sets a standard premium for all areas, or D, influences deductible amounts? The answer is A, adjusts premiums based on location. Territory rating adjusts premiums based on the geographic location of the insured property, reflecting local risk factors such as crime rates and natural disasters.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Deposit premium and audit adjustment math. What is the primary purpose of a deposit premium in insurance? Is it A, to pay for claims immediately, B, to secure coverage and adjust based on actual exposure, C, to cover administrative costs, or D, to provide a discount on future premiums? The answer is B, to secure coverage and adjust based on actual exposure. A deposit premium is an initial payment made to secure coverage and is adjusted based on actual exposure during the policy period. A business owner receives an audit adjustment notice indicating they owe an additional $2,000 due to increased payroll. What is the most likely reason for this adjustment? Is it A, the business had fewer employees than expected, B, the initial deposit premium was too high, C, the actual payroll was higher than estimated, or D, the policy coverage was reduced? The answer is C, the actual payroll was higher than estimated. The audit revealed higher actual payroll than estimated, leading to a premium adjustment to reflect the increased risk. How is the final premium determined after an audit adjustment? Is it A, by adjusting the deposit premium based on actual exposure, B, by multiplying the deposit premium by a fixed rate, C, by adding a standard fee to the deposit premium, or D, by reducing the deposit premium by a percentage? The answer is A, by adjusting the deposit premium based on actual exposure. The final premium is calculated by adjusting the initial deposit premium based on the actual exposure determined during the audit. Claims, losses, and deductibles. Post-deductible claim payouts. A homeowner files a claim for water damage after a storm. The deductible is $1,000, and the total damage is assessed at $5,000. How much will the insurance company pay? Is it A, $1,000, B, $4,000, C, $5,000, or D, $6,000? The answer is B, $4,000. The insurance company will pay the total damage amount minus the deductible. Therefore, $5,000 minus $1,000 equals $4,000 will be paid by the insurer. What is the primary purpose of a deductible in an insurance policy? Is it A, to increase the premium, B, to cover administrative costs, C, to reduce small claims and share risk, or D, to guarantee full coverage? The answer is C, to reduce small claims and share risk. A deductible is designed to reduce the number of small claims and lower the insurer's risk by having the policyholder share in the initial cost of a claim. A business owner has a policy with a $2,500 deductible. After a fire, the damages are $10,000. What is the post-deductible payout? Is it A, $7,500, B, $10,000, C, $2,500, or D, $12,500? The answer is A, $7,500. The payout is calculated by subtracting the deductible from the total damages. $10,000 minus $2,500 equals $7,500. Coinsurance penalty calculations. A business insured for $500,000 with an 80% coinsurance clause suffers a $200,000 loss. The property is valued at $700,000. What amount will the insurer pay? Is it A, $160,000, B, $178,571, C, $200,000, or D, $140,000? The answer is B, $178,571. The required insurance is $560,000. The insured has $500,000, so the insurer pays $500,000 divided by $560,000 of the $200,000 loss, which is $178,571. What is the primary purpose of a coinsurance clause in an insurance policy? Is it A, to reduce premiums, B, to eliminate deductibles, C, to ensure adequate coverage, or D, to increase insurer profits? The answer is C, to ensure adequate coverage. Coinsurance clauses encourage policyholders to insure their property to a certain percentage of its value, ensuring adequate coverage and sharing risk between insurer and insured. A homeowner with a $300,000 property value and a 90% coinsurance requirement has $250,000 in coverage. After a $100,000 loss, how much will the insurer pay? Is it A, $92,593, B, $100,000, C, $85,000, or D, $75,000? The answer is A, $92,593. The required insurance is $270,000. The insured has $250,000, so the insurer pays $250,000 over $270,000 of the $100,000 loss, which is $92,593. Aggregate cap and remaining limits. A company has an insurance policy with an aggregate cap of $500,000. After a series of claims totaling $450,000, what is the remaining limit available for future claims? Is it A, $0, B, $50,000, C, $450,000, or D, $500,000? The answer is B, $50,000. The remaining limit is calculated by subtracting the total claims from the aggregate cap. Thus, $500,000 minus $450,000 equals $50,000. What does an aggregate cap in an insurance policy represent? Is it A, the maximum total payout for all claims in a policy period, B, the maximum payout for a single claim, C, the minimum deductible amount, or D, the total premium paid for the policy? The answer is A, the maximum total payout for all claims in a policy period. An aggregate cap is the maximum amount an insurer will pay for all claims during a policy period. It limits the insurer's total liability. After a natural disaster, a business files multiple claims totaling $600,000 under a policy with a $1 million aggregate cap. What is the maximum additional amount they can claim? Is it A, $600,000, B, $1 million, C, $400,000, or D, $0? The answer is C, $400,000. The maximum additional amount is the difference between the aggregate cap and the total claims filed. $1 million minus $600,000 equals $400,000.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Cancellation, refunds, and timing. Pro rata refunds. A customer cancels their insurance policy halfway through the term. How should the refund be calculated? Is it A, no refund is given, B, a pro rata refund is issued, C, a flat fee is deducted before refunding, or D, the full premium is refunded? The answer is B, a pro rata refund is issued. In this scenario, a pro rata refund is appropriate because the policy was canceled halfway through the term, meaning the customer should be refunded for the unused portion of the policy. What is a pro rata refund? Is it A, a refund based on the unused portion of a service, B, a full refund regardless of usage, C, a refund with a fixed deduction, or D, a refund issued at the end of a contract? The answer is A, a refund based on the unused portion of a service. A pro rata refund is a refund calculated based on the unused portion of a service or policy, ensuring the customer receives back the amount corresponding to the time remaining. If a policyholder cancels their policy after 8 months of a 12-month term, what refund should they expect? Is it A, no refund as most of the term is used, B, a full refund of the premium paid, C, a refund for the remaining 4 months, or D, a refund minus a cancellation fee? The answer is C, a refund for the remaining 4 months. The policyholder should receive a pro rata refund for the 4 months remaining, as they have used 8 months of the 12-month term. Short rate refunds. A client cancels their insurance policy after 6 months of coverage. The policy was originally for 12 months. How is the refund calculated if a short rate refund applies? Is it A, full refund of remaining premium, B, refund minus a penalty, C, pro rata refund, or D, no refund? The answer is B, refund minus a penalty. A short rate refund involves a penalty for early cancellation, meaning the refund is less than the pro rata amount. This discourages early termination of policies. What is a short rate refund? Is it A, a full refund of the premium, B, a refund with no deductions, C, a refund minus a penalty, or D, a refund based on the time remaining? The answer is C, a refund minus a penalty. A short rate refund is a refund of the unearned premium minus a penalty for early cancellation, which is less than a pro rata refund. An insured cancels their policy 3 months into a 1-year term. What refund type applies if the insurer uses short rate calculations? Is it A, full refund, B, pro rata refund, C, no refund, or D, refund minus penalty? The answer is D, refund minus penalty. Short rate calculations apply a penalty for early cancellation, resulting in a refund that is less than the pro rata amount. Unearned earned premium determination. What is the term used to describe the portion of a premium that has not yet been earned by the insurer? Is it A, earned premium, B, refundable premium, C, unearned premium, or D, prorated premium? The answer is C, unearned premium. Unearned premium refers to the portion of the premium that corresponds to the coverage period remaining on an insurance policy. It is not yet earned by the insurer. A client cancels their insurance policy halfway through the term. How should the insurer calculate the refund amount? Is it A, based on the total premium paid, B, based on the unearned premium, C, based on the earned premium, or D, based on a flat fee? The answer is B, based on the unearned premium. The insurer should calculate the refund based on the unearned premium, which is the portion of the premium corresponding to the remaining coverage period. How is the earned premium calculated in an insurance policy? Is it A, by multiplying the total premium by the elapsed policy period, B, by dividing the total premium by the number of claims, C, by subtracting the unearned premium from the total premium, or D, by adding the unearned premium to the total premium? The answer is A, by multiplying the total premium by the elapsed policy period. The earned premium is calculated by multiplying the total premium by the fraction of the policy period that has elapsed.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Ratios and financial analysis. Loss expense and combined ratios. What does the combined ratio measure in insurance financial analysis? Is it A, the profitability of an insurance company, B, the liquidity of an insurance company, C, the solvency of an insurance company, or D, the growth rate of an insurance company? The answer is A, the profitability of an insurance company. The combined ratio measures the profitability of an insurance company by comparing incurred losses and expenses to earned premiums. A ratio below 100% indicates profitability. An insurance company reports a loss ratio of 70% and an expense ratio of 25%. What is the combined ratio, and is the company profitable? Is it A, 105%, not profitable, B, 95%, not profitable, C, 95%, profitable, or D, 100%, break even? The answer is C, 95%, profitable. The combined ratio is 95%. Since it is below 100%, the company is profitable, indicating that its underwriting activities are generating a profit. Which component is not included in the calculation of the combined ratio? Is it A, loss, B, expense ratio, C, earned premiums, or D, investment income? The answer is D, investment income. Investment income is not included in the combined ratio. The combined ratio focuses on underwriting performance, which includes loss and expense ratios. Rate adequacy and trend analysis. A company notices a steady increase in claims over the past 3 years. What analysis should they perform to ensure their rates remain adequate? Is it A, conduct a competitor analysis, B, perform a SWO analysis, C, conduct a trend analysis, or D, implement a new marketing strategy? The answer is C, conduct a trend analysis. Trend analysis helps identify patterns in claims data over time, allowing the company to adjust rates to maintain adequacy. Ignoring trends could lead to insufficient rates. What is the primary purpose of rate adequacy analysis in financial management? Is it A, to increase market share, B, to ensure premiums cover expected claims, C, to reduce operational costs, or D, to enhance customer satisfaction? The answer is B, to ensure premiums cover expected claims. Rate adequacy analysis ensures that the premiums collected are sufficient to cover expected claims and expenses, maintaining financial stability. An insurance analyst is reviewing a portfolio with fluctuating loss ratios. What should they assess to determine if current rates are adequate? Is it A, analyze historical loss trends, B, review customer feedback, C, evaluate marketing campaigns, or D, conduct a competitor pricing review? The answer is A. Analyze historical loss trends. Analyzing historical loss trends helps determine if fluctuations are temporary or indicative of a need for rate adjustments. Experience modification factors. A manufacturing company notices a significant increase in their workers' compensation premiums. They suspect it might be due to their experience modification factor. How can they verify if this factor is impacting their premiums? Is it A. Consult with a financial advisor? B. Review their insurance policy for the experience modification factor? C. Increase safety measures in the workplace? Or D. Negotiate with the insurance provider? The answer is B. Review their insurance policy for the experience modification factor. The experience modification factor directly affects workers' compensation premiums. By reviewing their insurance policy, the company can identify the factor's impact on their premium calculations. What is the primary purpose of an experience modification factor in insurance? Is it A. To adjust premiums based on historical loss experience? B. To provide a fixed discount on all insurance policies? C. To standardize premiums across all industries? Or D. To penalize companies with high employee turnover? The answer is A. To adjust premiums based on historical loss experience. The experience modification factor adjusts insurance premiums based on a company's historical loss experience, incentivizing safety improvements and accurate risk assessment. A construction firm with a high experience modification factor is looking to reduce its workers' compensation costs. Which strategy could most effectively lower their factor over time? Is it A. Switch insurance providers annually? B. Hire more temporary workers? C. Implement comprehensive safety programs? Or D. Increase the deductible on their policy? The answer is C. Implement comprehensive safety programs. Implementing comprehensive safety programs can reduce workplace accidents, leading to fewer claims and a lower experience modification factor over time. Property valuation and coverage limits. ACV versus replacement cost calculations. John's house was damaged in a storm, and he has an insurance policy that covers replacement cost. If the replacement cost is $200,000 and the actual cash value is $150,000, how much will John receive for the repairs? Is it A. $150,000, B. $200,000, C. $175,000, or D. $0? The answer is B. $200,000. Since John's policy covers replacement cost, he will receive the full $200,000 needed to repair his house, not the depreciated value. What is the primary difference between actual cash value and replacement cost in property insurance? Is it A. ACV is higher than replacement cost? B. Replacement cost includes depreciation? C. ACV includes depreciation, replacement cost does not? Or D. Both are calculated the same way? The answer is C. ACV includes depreciation, replacement cost does not. ACV accounts for depreciation, while replacement cost covers the full cost to replace the item without depreciation. Emily's roof was damaged by hail, and her policy covers actual cash value. If the roof's replacement cost is $10,000 and it has depreciated by 30%, how much will her insurance pay? Is it A. $7,000, B. $10,000, C. $3,000, or D. $0? The answer is A. $7,000. The insurance will pay $7,000, which is the replacement cost minus the 30% depreciation. 80% coinsurance rule and underinsurance penalties. A homeowner has a property valued at $200,000, but only insures it for $120,000. If a fire causes $50,000 in damage, how much will the insurance cover under the 80% coinsurance rule? Is it A, $40,000, B, $30,000, C, $50,000, or D, $20,000? The answer is B, $30,000. The homeowner is underinsured, covering only 60% of the value. The insurance will cover 60% of the $50,000 damage, which is $30,000. What is the minimum coverage amount required to avoid penalties under the 80% coinsurance rule for a property valued at $500,000? Is it A, $300,000, B, $350,000, C, $400,000, or D, $450,000? The answer is C, $400,000. To avoid penalties, the property must be insured for at least 80% of its value, which is $400,000. A commercial building valued at $1 million is insured for $700,000. If a storm causes $200,000 in damage, how much will the insurance pay under the 80% coinsurance rule? Is it A, $140,000, B, $160,000, C, $200,000, or D, $100,000? The answer is A, $140,000. The building is insured for 70% of its value, so the insurance will cover 70% of the $200,000 damage, which is $140,000. Limit applications across multiple claims. A homeowner has a policy with a $200,000 limit per claim. After a storm, they file two separate claims for $150,000 and $100,000. How much will the insurer pay in total? Is it A, $250,000, B, $150,000, C, $200,000, or D, $100,000? The answer is C, $200,000. The insurer will pay $200,000 in total because the policy limit applies to each claim separately, not cumulatively. Each claim is evaluated independently up to the policy limit. What is the primary purpose of a coverage limit in property insurance? Is it A, to increase premiums, B, to cap the insurer's payout, C, to determine deductible amounts, or D, to provide unlimited coverage? The answer is B, to cap the insurer's payout. Coverage limits define the maximum amount an insurer will pay for a covered loss, protecting the insurer from excessive payouts and helping policyholders understand their coverage scope. A business has a policy with a $500,000 limit per occurrence. After a fire, they file two claims, one for $300,000 and another for $250,000. What is the total payout? Is it A, $500,000, B, $550,000, C, $300,000, or D, $250,000? The answer is A, $500,000. The total payout is $500,000 because the policy limit applies per occurrence. Both claims arise from the same event, so the limit caps the total payout. Inflation guard and GIP payout calculations. Sarah purchased a car with a loan and her vehicle was totaled in an accident. The insurance payout is $15,000, but she owes $18,000 on her loan. How much will GIP insurance cover? Is it A, $0, B, $1,500, C, $3,000, or D, $5,000? The answer is C, $3,000. GIP insurance covers the difference between the insurance payout and the loan balance. In this case, it covers $3,000, which is the difference between $18,000 and $15,000. What is the primary purpose of an inflation guard endorsement in property insurance? Is it A, to reduce the premium cost over time? B, to adjust coverage limits in line with inflation? C, to provide additional liability coverage? Or D, to cover depreciation of property? The answer is B, to adjust coverage limits in line with inflation. An inflation guard endorsement automatically increases the coverage limits to keep pace with inflation, ensuring that the property is adequately insured over time.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.